Hi, I'm Steve. I'm going to share my thoughts on how you can achieve a better financial future. Please remember, I don't know anything about your situation, so think for yourself and use what fits. Let's start off by talking about what has been called the only free lunch in the stock market. We know that investors require a higher expected return to compensate them for making a riskier investment. A well-diversified or efficient portfolio will have the lowest possible amount of volatility for a given level of return. This volatility will be less than that of a single investment or a poorly diversified group of investments without sacrificing returns. That's the free lunch, a smoother ride for free. The cornerstone of diversification is the concept of correlation. Correlation is measured by a statistic called R squared. And R squared of 1 means two things will react to an event in exactly the same way. An R squared of 0 means two things have no connection at all. Optimal portfolio diversification is achieved by combining assets with low R squared. The key here is to spread your bets among different asset classes or stocks that will not react similarly to an outside event. In other words, don't put all your eggs in one basket. A good example is if the economy goes into a recession, high-end retailers will suffer, but pet food sellers won't even notice. Having both of these stocks in your portfolio will tend to smooth out the impact of economic cycles. Everyone can make common sense investments like this that reduce the volatility of a portfolio. However, minimizing volatility at a given risk level requires serious statistics and math. According to finance theory, an optimally diversified portfolio can be created at any level of risk. The higher the risk, the higher the expected returns, but only these perfectly efficient portfolios which have zero diversifiable risk maximize the trade-off. Collectively, these perfect portfolios create a line called the efficient frontier. Sounds like an interesting place to visit, but it's actually a great place to invest. The good news here is you don't need to be a math major to get the benefit. Most target date retirement funds are designed this way. If you're going to need to draw on the money beginning in the year 2060, for instance, investing in a fund called something like Target Retirement 2060 is a great way to go. Most major brokerages, such as Vanguard and Fidelity, offer these products at relatively low cost. Otherwise, give a little thought to diversification as you invest. Your portfolio won't be perfectly efficient, but it's common sense to spread your bets across different industries, economies, and asset types. Well, that's it for this session. Thanks for watching, and I'll see you next time.